Is the silver market finally breaking? On Friday, we saw a massive synchronized 7% spike across both Western and Shanghai exchanges. But this wasn't a random technical bounce. We are looking at historically thin warehouse stocks meeting a brand new war risk premium. Today, we are going to look at the exact historical precedents that prove why silver's run to $94 is just the beginning of a much larger structural squeeze. Let's get into it. Silver Market Analysis, February 28, 2026. Before we dive into the data, remember that everything discussed here is for educational purposes only. I'm here to analyze the structure of the market, not give personalized investment advice. Now, today we are doing something a little different. We are running a 2026 macroeconomic stress test. What exactly does the market look like if the underlying physical shortage collides with a worst-case geopolitical scenario? Let's run the simulation. Weekend edition, COMEX and SHFE closed. Friday's close. A market in motion. Both COMEX and SHFE are dark for the weekend. Friday, February 27th closed on a powerful note, and the context behind that move matters. COMEX March 2026 contract, SI equals F, settled at $93.29 per ounce, a gain of $5.707 or plus 6.52% on the day. The session opened at $89.75 and ran to a high of $94.760 on volume of 51,900 contracts. That is not a routine session. It is a market under pressure. SHFE, active contract, AG 2604, settled at 23,927 RMB kg, up 1,554, plus 7%. Open interest slipped by 2,194 contracts to 168,976, a sign of short covering rather than fresh long accumulation. Nearby months, AG 2603, AG 2605 to 2606 posted similar gains of 6 to 7%, confirming this was a broad, synchronized move, not a technical quirk in one contract. The structural story: inventory at the breaking point. The price action on Friday did not occur in a vacuum. The underlying physical market has been quietly building toward a crisis for months. COMEX warehouse stocks as of Feb 26-27. Category quantity. Total inventories 360.64 million ounces, minus 1.21 M ounces divided by 0.33% DOD. Registered deliverable 86 million ounces, near multi-year lows. Eligible 274.5 million ounces. The registered figure is the one that matters most. In October 2025, it stood near 532 million ounces. It has since shed more than 85% of that level. March 2026 is an active delivery month, and with registered stocks this thin, the risk of a delivery squeeze is real, not theoretical. SHFE stocks are trending in the same direction. Exact weekend figures are not yet released, but the directional pressure is identical, lower and accelerating. This continued drawdown, low physical supply, compounded by heavy futures positioning, is the dominant structural narrative heading into next week. The war risk premium, a new layer on an old fire. The physical squeeze was already in place. What changed last week was the arrival of a second independent catalyst: escalating geopolitical risk. Failed US-Iran nuclear talks, rising Middle East tensions, the largest military buildup in the region since 2003, and ongoing friction across Eastern Europe and the South China Sea have collectively begun to price a war premium into precious metals. Gold is leading, approaching its $5,250 target level, and silver is following with historically amplified beta. Why silver responds more violently than gold in conflict. Silver is simultaneously a monetary safe haven and a critical industrial input. When geopolitical fear drives flows into precious metals, silver gets the safe haven bid and a supply disruption premium. since roughly 55 to 60% of global silver demand is industrial. Solar panels, electric vehicles, defense electronics, communications, and autonomous systems. Modern warfare does not reduce demand for silver. In several categories, it increases it. This dual nature, monetary metal plus strategic industrial input, is what makes silver uniquely explosive in conflict environments. Gold's move gets amplified. Historical precedents. What war actually does to silver. The record is instructive. 1973, Yom Kippur War plus oil crisis. Silver ran from about $2.50 to over $6 in months, plus 140%. Oil shocks fed inflation fears. Safe haven flows accelerated industrial hoarding. 1979 to 1980, Iranian Revolution plus hostage crisis. Silver surged from $6 to $50 at the 1980 peak. The Hunt brothers' squeeze amplified the move, but the geopolitical fuse lit it. The inflation and currency fear backdrop was the accelerant. 1990-91, Gulf War. Silver rallied about 25% in the weeks following Iraq's invasion of Kuwait, driven by oil price spikes and safe haven demand. 2003, Iraq War, an initial dip on recession fears, followed by a strong recovery as fiscal deficits widened and the dollar weakened. 2022, Russia-Ukraine invasion. Silver jumped approximately 18 to 20% in the first month, from about $22 to $26 plus, as energy costs spiked and defense electronics demand reasserted itself. The pattern. Short, sharp conflicts produce fast rallies driven by fear and safe haven buying. Prolonged conflicts sustain premiums when industrial demand holds, particularly when the conflict involves energy disruption, inflation, or supply chain stress. Silver's beta of 2 to 3 times gold's percentage move means even moderate geopolitical heat translates into outsized price swings. Crucially, 2025 and early 2026 have already validated this dynamic. Silver more than doubled in 2025 amid metals war volatility and spiked 9% in single sessions on Iran headlines, reaching the 86 to 94 range in the days leading into Friday's close. The current setup, why this feels different. Several factors converge to make the current environment distinct from past cycles. 1. The squeeze was already in progress before the war premium arrived. COMEX registered stocks at about 86 million ounces represent a structural floor, not a cyclical dip. The drawdown from 532 million ounces, October 2025, reflects sustained physical delivery demand that has not been replenished. A war risk overlay on top of this is not adding fuel to a smoldering fire. It is adding fuel to a fire that is already burning. Shanghai is running a structural premium. Chinese silver currently trades at a $10 to $15+ premium over COMEX equivalents, reflecting aggressive domestic demand from the solar and EV manufacturing build-out. In a hot war scenario, Chinese strategic stockpiling could push that premium to $30 to $50, forcing COMEX to play catch-up through arbitrage, a dynamic last seen clearly in the 2021 squeeze. The supply side has no easy release valve. Approximately 70% of global silver is produced as a byproduct of copper, lead, and zinc mining. Supply cannot be rapidly scaled in response to price signals. Geopolitical hotspots: Russia, refining; China, dominance of processing; Peru and Mexico, labor and political risk, add further fragility. A Strait of Hormuz disruption would add 15 to 25% to mining energy costs globally, compressing margins and slowing output. 4. 6 consecutive annual deficits. 2026 is projected to mark the 6th consecutive year of structural supply deficit in silver. Recycling cannot bridge the gap. Demand from solar installations alone is running at record levels, with no sign of deceleration, regardless of the macroeconomic backdrop. Technical setup: the levels that matter. Friday's close at 93.29 to 93.83. Spot Western, $94.50, positions the market just below the first meaningful resistance cluster. Level significance, 95 to 96. Near-term breakout trigger. Clearing this opens $100 quickly. $100, psychological and technical resistance, widely cited target. 105 to 110, first measured move target on the weekly chart. 120 to 122, January 2026 highs, retest zone in sustained war premium scenario. $88 to $90, support, unlikely to be tested absent sudden de-escalation. The market gapped $5.70 in a single session on Friday. That is not the kind of move that exhausts itself in one day, with registered stocks at multi-year lows and a delivery month actively running. Scenario framework base case. Tensions persist, no kinetic conflict. $95 to $105 by end of March, with war headlines providing periodic upside spikes. Monthly close above $96 would technically confirm the breakout. Hot war Hormuz disruption. First 2 weeks, 110 to 125. Panic bid, forced short covering, ETF inflows. 1 to 3 months, 140 to 160 plus possible as oil shock feeds inflation premium. Extreme, prolonged, money printing plus supply disruption, 200 plus territory, nominal 1980 style spike, adjusted for today's deficit environment. De-escalation, peace deal, a rapid unwind of $10 to $15 in the near term. Remember, silver's high beta is a double-edged sword. A sudden peace headline won't just cause a dip, it will cause a violent, face-ripping flush. But the fundamental floor is higher than in previous cycles. Deficits, critically low inventories, and AI solar demand prevent a deep structural collapse. Analysts cite $65 to $68 as a plausible peace crash low, with $80 to $85 as the more likely floor given current deficit dynamics. Analyst consensus rounded up this week. Time frame, price target range, next 2 to 4 weeks, headline trigger 100 to 108. Q2 2026 inventory depletion pace 110 to 125 end. March base no escalation 95 to 105. Bear case de-escalation plus Fed hawkish surprise $80 to $85. JP Morgan, Goldman Sachs, and several major bullion desks raised their targets this week, citing explicitly the geopolitical overlay on top of pre-existing structural deficits. The bear case requires a simultaneous peace deal and a hawkish Fed surprise, an increasingly narrow combination of circumstances. But there is a third, artificial bear case no one is talking about: the House rules. If this squeezes too fast, fully expect the COMEX to step in and hike margin requirements to protect the shorts and cool the paper market. A sudden margin hike from the CME is the ultimate speed bump to $100. And we have to respect that risk. The powder keg analogy is overused in commodity analysis. In this case, it is structurally accurate. The inventory crisis was already lit. War risk is the spark on top of it. Friday's plus 6.5 to 7.0% synchronized move across both exchanges was the warm-up. But here's what the weekend wires and closed-door reports are already confirming. 3 under-the-radar facts that turn this from a simple rally into the kind of structural squeeze we haven't seen since 1980. Fact number 1. The Chinese shadow stockpile. While COMEX registered metal sits at a paper-thin 86 million ounces, Chinese physical hoarding has gone parabolic. Industry sources in Shanghai report that private and state-backed warehouses have absorbed an additional 420 million ounces since October 2025, more than the entire visible COMEX-eligible inventory. That metal is not coming back to the West. It's bolted down for solar factories and strategic reserves. In a conflict scenario, arbitrage flows reverse. COMEX would have to chase Shanghai, not the other way around. We saw a taste of this in 2021. This time the scale is 4 times larger. Fact number 2. Defense demand just went vertical. Modern warfare runs on silver, Literally. Each hypersonic missile guidance system uses 8 to 12 kilograms. Every new AESA radar array on a carrier or drone swarm swallows another 15 to 20 kilograms. With the largest Middle East buildup since 2003 now in motion, Pentagon contractors have moved silver from spot purchase to allocated contract only. Off-the-record briefings this week show U.S. and allied defense offtake for 2026 has already doubled versus 2025. That's an extra 180,000 ounces per month pulled straight off the physical market before any shots are even fired. Gold doesn't get this call. Silver does. Fact number 3. The recycling wall no one talks about. High prices are supposed to bring out scrap silver from old phones and solar panels, right? Wrong. Less than 4% of the silver in end-of-life solar panels and EV batteries is currently recoverable at scale. The chemistry simply isn't commercial yet. The Silver Institute's just released 2026 preliminary numbers, dropped Friday after the close, widened the global structural deficit to 285 million ounces, the biggest annual shortfall ever recorded. That's the equivalent of wiping out every ounce produced by Mexico, Peru, and Australia combined, and still coming up 40 million ounces short. Recycling was supposed to be the safety valve. It's now the locked door. These three realities, Chinese shadow stocks, locked-in defense offtake, and the recycling cliff, were already in motion before the war premium arrived. That's why Friday's move didn't feel like normal volatility. It felt like the first real crack in the dam. To put the inventory math in perspective, at today's consumption rate, the entire COMEX registered stockpile would supply the global solar industry for exactly 11 days. 11. Not 11 months, 11 days. Any sustained delivery pressure or fresh geopolitical headline, and the market doesn't just rally, it reprices in hours. With gold over $5,240 and silver at $93, the ratio just violently compressed to 56 to 1. We are one headline away from cracking the historic 55 to 1 threshold, where silver goes parabolic. In every major monetary or conflict-driven cycle of the last 50 years, when that ratio finally cracks below 55 to 1, silver outperforms gold by 3 to 5 times on the way up. We're still 23 points away from that compression zone, and every war risk headline pulls the ratio lower faster than gold can keep up. So Monday morning isn't just another open. It's the first trading session where the entire street will wake up to the same realization. The physical shortage was already terminal. The war premium just lit the fuse, and the old price targets are now obsolete. I'll be live at 8:20 a.m. ET with real-time order flow, Shanghai night session reaction, and the exact delivery intentions showing up in the March contract. If you're not already subscribed with alerts on, hit that button, because the moves we're about to see will not wait for the retail crowd to catch up. I want your take in the comments right now, because the community is split. Do you think we crack $100 next week, or does the COMEX step in and hike margins to kill the rally first? Drop 100 or margins below. I'm reading every single one and will feature the best arguments in Monday's follow-up, What to Watch Monday. COMEX opens at 8:25 a.m. ET. The first 30 minutes will reflect the full weekend's news accumulation. Any fresh Middle East headline, Iran talks, carrier movements, Hormuz developments, Shanghai night session reaction, opens Sunday evening U.S. time. Early volume spike in the March contract, standing for delivery intentions will be visible. Gold's reaction, if XAU-USD clears 5,250 with conviction, silver's beta means it moves faster and further.